Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, the Director of Investor Education here at PassiveInvesting.com. And I'm so excited for you guys to join me today. I do this show live every Tuesday so you can learn the ins and outs of passive investing. And if you haven't done so already, make sure to go to PassiveInvesting.com to register for future masterclasses, because the whole point of these masterclasses is to help you invest with confidence, be it your first investment or your 50th investment. We go through all the different ins and outs of passive investments. And today we're going to be talking about first position lien real estate debt funds. But before we get into today's topic, again, remember to check out passiveinvestingwithwhitney.com to get invitations for future masterclasses. Jump on my calendar if you'd like to talk about passive deals, as well as see our currently open deals. We've got a few cool things going on here at passiveinvesting.com. Now, jumping into today's topic, we are going to talk about the ins and outs of first position lien debt funds. So specifically as it's tied to real estate. But I didn't just want to talk about like our opportunity here at passiveinvesting.com, but really arm you with, again, the ins and outs, the pros and cons, the advantages, disadvantages, things that you should be looking out for as it pertains to first position lien real estate debt funds. Now, if you've never joined me before, my name is Whitney. I'm the Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I invest in real estate. I started off investing in 2002, living, flipping, and house hacking, scaled to 36 single family rental portfolio. I've invested in the multifamily deal on my own. I have also syndicated over 10 projects. I've raised capital for over 29 deals. Anyways, all of this is in service of one goal. Everything that I've made has been in service of creating passive streams of income. That way that both grow my cash flow as well as my equity and help accelerate my velocity of money with tax benefits in order to do one thing, and that is get 100% control and choice, most importantly, choice on how I spend my time. I don't think any of us here really want to ride off into the sunset and lay on a beach all day long. Maybe you do, but you want to have like that choice on how you get to spend your time. Now, I always show the vanity metrics. Everybody wants to know, how big is your portfolio? Well, my husband and I scaled to date personally over 6,500 multifamily units, 2,200 self-storage units, 15 express car washes, and a myriad of other deals as well. Whoop. So, and we can help you do that here at PassiveInvesting.com. We've have 1.4 billion assets under management, 28.9% ARR on our full cycle deals, and made over $51 million in investor distributions to our limited partners. And also, it's not a stat that we rarely talk about, which is made over 230 million, actually, I should say 223 million in rehab wallet loans, soon to be 230 million by the end of the year. Now, for this webinar is for educational purposes only. It's not financial, legal, or tax advice. So anything we talk about today, make sure to take that to your consulting team before making any investment decisions. Okay, now I promise you we're going to talk about first position lien debt funds. Now, I always like to define what it is we're talking about before we dive into why should you care, how do you invest in it, how do you start evaluating this? Well, let's talk about just at a high level what a real estate debt fund is. A real estate debt fund is a type of investment that specializes in providing debt or financing for real estate related projects and investments. Okay, so essentially these funds, okay, you can actually go originate your own note, right? Find an investor that's buying a property and you could lend them money. Okay, that's originating the note. The funds do this in aggregate. So the funds will raise capital from investors and then make loans or invest in debt instruments that are backed by real estate assets. Okay, so you as investing in a fund don't actually own that real estate, but you're invested in a business that holds notes across all that real estate. Now, real estate debt funds are typically managed by professional investment teams, okay, with experts in real estate and in finance and lending. Now, there's a myriad of different fund availability out there, okay? There is mortgage funds, commercial real estate debt funds, residential real estate debt funds. There's funds that focus on debt for distressed properties. There's funds that focus specifically on private debt instruments. There are funds that just write loans, and it can be first position, second position, it can be any type of lien of the loan. The fund could be, a crowdfunding type of debt fund. And again, then we've got funds, that break down on their lien position. Maybe they're invested in senior debt only, the first position, or maybe the second position or third position, which is known as mezzanine debt. So you really have a choice on which type of fund you go into. Now, we're going to specifically focus on a first position lien debt fund. Okay, and what does that actually mean? Well, a first position lien debt fund is one that invests in a pool of loans, okay, that hold a senior or first position claim on the assets, okay? By them being in this first or senior position, that loan, okay, that lien, that debt holder actually gets first dibs on any of the cash flows or the actual value of the asset in the event of any bankruptcy or default. Simpler terms, if the borrower that issued the debt were to run into the financial trouble or default on their obligations, the holders of that first position lien real estate debt fund would have the first right to the asset, okay, that secures the debt. And all other creditors would have lower claims to the deal. So that means in order for that, if the borrower got foreclosed on, the first position lien, real estate debt fund, they would foreclose on the property, sell it. They would get paid back first. Everybody else takes a back seat. All right. Now, what are some key characteristics? This is kind of the why. Why do we need to care about, potentially adding a first position lien real estate debt fund to our portfolio? And there's a few reasons why. One is the priority. Okay, it puts you in a priority position in case there's a default or bankruptcy is claimed. So, even say the borrower, say they have to declare bankruptcy and they have to sell off their assets to start making creditors whole. Guess what? You're in a first position lien in that particular asset. And so you get paid first before everybody else. Because you're in that first position, it lowers your risk. Okay, to be in that position. Because if you're in a second position, you're kind of crossing your fingers and hoping that there's enough equity in that asset to pay off the first position and then also the second position and maybe any other creditors that are behind them. Okay, but let's think about the worst not happening. Okay, maybe there's just not even bankruptcy, the loans are performing. Okay, that first position lien real estate debt fund can actually provide some stable fixed income, okay, because that first position lien, especially when we're talking about residential real estate, something that we specialize in here within passiveinvesting.com and our rehab wallet team, it's providing fixed and stable income, okay? So there's a regular monthly payment that borrower is making. We're also making that regular distribution to the investor after the selling and expenses. One of the cool characteristics of a first position real estate debt fund is diversification. Now, you could go originate your own debt. You could find a slew of borrowers, on various platforms and really start originating your own notes. But you're going to have to deploy an immense amount of capital to achieve diversification over borrowers, over markets, over deals. Whereas if you invest in a first position lien real estate debt fund, you can deploy capital in one shot, okay, say $100,000 or $500,000, and you would get instant diversification over borrowers, which is one of your bigger risks, over the market and over the actual individual deal. All right. Now, I'm going to kind of get into some specifics on how we do this with our rehab wallet team. That's our lending arm. But, take some notes here as you're evaluating first position lien real estate debt funds, because it's not just about vetting the operator that is raising the capital. You actually have to vet not only the operator raising the capital, but who is the lender deploying the capital? What is their lending plan? What is their strategy? For us, with our Rehab Wallet team, our Rehab Wallet team is focused on lending to single family residential fix and flippers, rehabbers, primarily in the Southeast. That's what the area that we know and love the best. We're looking to originate debt that is low leverage, 65% or lower. Now, we used to actually, year and a half ago, we were originating debt like between 70 and 75%. We're adjusting to the market and what's happening out there and lowering our risk position to get into that 60 to 65% range. We also like that short-term loan, okay, deploying capital, in 6-month increments. So it goes out, comes back, goes out, comes back. Okay. And we like taking that first position lien, doing that first position loan, that lien position. Now, in the Rehab Wallet's lending strategy, their lending plan, the borrower is thoroughly vetted and guarantees the loan. Okay, so you can have a couple of different ways. Maybe the loan is non-recourse. There's really nothing preventing the borrower from walking away should they face distress. We actually have our borrowers secure the loan. Okay, guarantee the loan. The loan is secured by the asset itself, and it also goes through a third-party valuation. Okay, so it's not just what we say the value is. It's not what the borrower says the value is of the property. We actually get an independent third-party team to go out and confirm what the borrower says the after repair value will be and what we actually think it will be internally. Now, again, this is the beauty of a first position lien real estate debt fund. Should the borrower not perform, we attempt to do a workout with them. Okay. Now, some people get really, they kind of like start rubbing their hands together. They're like, oh, if the borrower doesn't perform, I'm going to foreclose on the property. As a lender, you're not really in the game to foreclose on the property. Remember, you're in the game to get a secured, low risk, fixed, stable income position with no tenants, termites, toilets, or trash, right? That is the goal, okay? So in this case, if the borrower starts experiencing distress, for us and what our lending strategy is, it's not to foreclose immediately and take the property back, okay? Again, we want to work it out with the borrower to keep them, performing on the property. Now, should we need to? Yes, we are prepared to take over the asset. We've mitigated the downside, and we are prepared to take over the asset. And our team is ready to flex their muscle and skills of over 40 years of not only just lending, but also fix and flipping themselves to be able to get the asset to, disposed if they need to. Now, I already alluded to this. Okay, we're going to do a big deep dive here in November's boot camp on how to underwrite a first position lien real estate debt fund. But I've already alluded to this right now. You have to perform due diligence, not on just the operator raising the funds, but also on the lender deploying funds. So before you invest in any fund, just make sure that you understand what the lender's experience is with that asset class they're lending on and the market. What is their background and track record, and experience there? What is the background, track record, and experience of the operator raising the funds, right? Because this is a unique relationship. There's actually two operators here that you got to have your eyes on. And what is the background and experience of the operator deploying capital? Now, for us, here, we are vertically integrated. Rehab Wallet is, part of the passiveincome.com investing umbrella. Okay, it is one of our vertical strategies, but sometimes if you're looking at a real estate debt fund, they might be deploying into other lenders that you don't actually get to visualize. So make sure that you're asking those questions, not only just underwriting the fund itself, but also who's deploying the capital, because that is the person that is going to make you money. All right. Now, there's some other kind of cool perks of investing in first position lien real estate debt funds. One of my favorite perks, of course, I've already mentioned it, which is you get in this type of fund, you can get instant diversification over markets, loans, the borrower, and also the deals. Okay, so you get instant diversification over that area. You're not having, it saves you headache and heartache from trying to build and scale a portfolio yourself. Another perk would be, could you look for a fund that has a liquidity option to it? Okay, because these type of funds can be used for short-term investing. You place capital, and maybe there's a lockup period and then a redemption period. For us, we don't have a lockup period. We just have a 90-day redemption period. We often return capital way earlier than that 90 days. But that can be a short-term strategy. And then a longer-term strategy, does that fund offer compounding? Could you place your investments and keep your cash flow compounding? And this is the example that I'm showing here on the screen, of monthly compounding. Say this person invested $100,000 and, hit our 8% preferred return, on our PIC debt fund 1. Now, if they continue to reinvest their monthly distributions and did that religiously, say they were invested in a self-directed IRA, and in year 10, their actual annual return on their investment is actually 17%, not 8%. They more than doubled their effective annual return. So that can be extremely powerful. Now, again, I always have to wrap this up. Anytime that you're looking at a new asset to put in your portfolio, I should say asset class to put in your portfolio, you have to make sure that you are investing with experts, right? As a passive investor, you get to control your goals, your risk, your timeline. Okay, that's kind of like the first chunk. And the other 3 things are, you get to control who you invest with, where you invest, and what deals you go into. And that is the beauty of this, investing passively. So make sure you're investing with experts, people that can have knowledge of the strategy, that have the track record of performance, they have the ability to secure capital if needed, and reliably pool investor capital, okay, to keep that business plan going. And they have a professional team and network to actually support the investment. Not only does our, on our passiveinvesting.com side, do we have over 50 full-time team members working on behalf of our investors, but also on our Rehab Wallet side, we have a team there too with over 40 years of combined lending and real estate management experience. All right. If you're here live, don't go anywhere. We're about to open the floor for our Ask Me Anything session. If you are listening on your favorite podcast player of choice, I invite you to visit passiveinvestingwithwhitney.com. There, I've got a free ebook for you, Passive Investing Made Simple. Also, some other tools that can make investing in your first or next deal simpler. And then you can also join our Passive Investing Made Simple Masterclasses, boot camps, see our open deals, and also hop on the phone with me.